Welcome back to the channel. In today's video, I'm giving you a complete, in-depth USA tax guide designed especially for accountants and accounting students. Whether you're planning to work with US clients or just want to understand how American taxation works, this video will make everything clear and simple. Let's begin. Understanding the US tax structure. In the United States, taxes operate at three levels: federal taxes, collected by the IRS, state taxes, where each state has its own rules, and local taxes, where some cities and counties add extra taxes. An important fact to note is that the United States does not have VAT. Instead, it uses sales tax, which is totally different. Let's break the system down. Federal taxes. IRS federal taxes apply to every business in the US, no matter which state they operate in. Federal income tax businesses file federal tax returns based on their legal structure. For sole proprietorships, it's Form 1040 with Schedule C. For partnerships, the form is 1065. S corporations file Form 1120S while C corporations use Form 1120. LLCs have the option to choose how they want to be taxed. Most US businesses use pass-through taxation, meaning profits pass to the owner's personal tax returns. C corporations are taxed separately and may face double taxation. Next, let's talk about federal payroll taxes, a major responsibility for employers. Federal payroll taxes employers must withhold from employees federal income tax, Social Security, and Medicare. Additionally, employers must pay their own share of Social Security, their own share of Medicare, and the FUTA unemployment tax. Key payroll forms include Form 941, which is the quarterly tax return, Form 940 for annual unemployment, W-2 for employees, and W-3 for summary filings. Federal excise taxes. These apply only to certain industries, including fuel, alcohol, tobacco, heavy trucks, environmental fees, and airline travel. Businesses must file these using Form 720. Now let's talk about state-level taxes. Every state has its own tax authority, and rules can be very different from one state to another. State income tax. Some states charge income tax, while others do not. For example, Texas, Florida, Nevada, and a few others have no personal income tax. State franchise tax. Some states might also charge a franchise tax just for the privilege of doing business, like Texas, Tennessee, and California. State employer taxes. Moreover, states collect unemployment insurance tax, called SUTA. Businesses must register separately in each state they operate in. Sales tax is the biggest difference for accountants coming from outside the US. Remember, the USA has no VAT. Sales tax exists only at the final sale to customers and is not charged on business purchases. Each state, city, and county has its own sales tax rate, which means one business might be dealing with dozens of different tax jurisdictions. Nexus. The critical rule: sales tax depends on something called nexus. You must collect sales tax in a state if you have physical nexus, which includes having an office, employees, a warehouse, or inventory. Economic nexus applies usually when businesses reach $100,000 in sales or have 200 or more transactions in that state. This rule became strict after the Wayfair 2018 Supreme Court decision. Sales tax returns are filed monthly, quarterly, or annually, and they must be filed in every state where the business has nexus. This is why U.S. multi-state accounting is complex. Some cities and counties add their own taxes, such as local sales tax, gross receipts tax, or business license tax. For example, in Los Angeles, you might pay state, county, and city sales tax combined, which can reach nearly 10%. Now, let's discuss the accounting treatment in the USA. Sales tax collected from customers is a liability and not revenue. It is recorded as debit cash, credit sales revenue, and credit sales tax payable. Later, the payable is remitted to the state. Corporate tax is shown as an expense on the P&L and as a liability on the balance sheet until paid. It's important to also track employee withholdings and employer contributions carefully. Payroll liability accounts are essential for this. In the USA, a business may have several required filings. These include the federal income tax return, state income tax return, state franchise tax, sales tax returns, payroll tax returns, and annual business registration renewals. Record keeping usually requires keeping documents for 4 to 7 years. Businesses can face 4 types of audits: IRS audit, state income tax audit, state sales tax audit, and payroll or unemployment audit. Common audit triggers include large deductions, incorrect sales tax collection, and contractor misclassification. The role of an accountant in the USA includes maintaining GAAP-compliant books, preparing federal and state tax returns, registering clients for payroll and sales tax, managing nexus across states, filing monthly or quarterly tax returns, handling audits and compliance, and advising on tax-efficient structures. U.S. accountants often manage much more multi-state complexity compared to other countries. If you found this video helpful, make sure to like, share, and subscribe for more accounting and tax education content. Thanks for watching.